Hello viewers, this is Dr. Alok Chajed and you are on Already Late, your favorite channel for simplified learning on everything related to economy and personal finance. In this video, I will explain what swaps are and how are they used to reduce interest rate risk while investing in debt securities. This video is an answer to my viewer Abhishek Verma's question on how mutual funds use swaps. Thank you so much Abhishek for the wonderful question. Swap in simple English means to exchange. In finance too, the essence of swap is the same. You exchange something for something else. Swap is a type of agreement where two parties agree to exchange cash flow or liabilities over a period of time in the future. Now don't worry, I will explain with the help of a simple example. When you take a housing loan, you are typically offered a floating rate of interest, which means the interest on your home loan could go up or down depending on an external rate, which is most likely to be the repo rate. Now, in case you don't know what repo rate is, it's simply the rate at which any bank can borrow from the RBI. So coming back to our home loan, let's say the bank has given you a home loan of 50 lakhs, currently at an interest rate of 6.5%. The current repo rate is 4%. This means that your home loan is actually repo rate plus 2.5%. In future, if repo rate increases, your home loan rate will also increase, and if repo rate decreases, your home loan rate will decrease. Now, let us say that you are expecting RBI to increase repo rate in the coming days. This means an increase in your interest rate on the home loan, and this means higher EMIs. This is not a good situation to be in. You can avoid this by getting into an agreement with another party. In this agreement, you will agree to receive a floating rate of interest and pay a fixed rate of interest on the same amount of 50 lakh rupees. Let us say you are receiving interest of repo plus 2%, just for example, and paying 7% fixed interest rate. Now, you might be wondering, where do you get that 50 lakhs from? You don't have to worry because this 50 lakhs is just a notional amount and your actual cash flow will only be the difference in these interest rates. To make it absolutely clear, let us explore what happens as and when there is a change in repo rate and you have housing loan and this agreement together. So you have two things to deal with. First, you are paying interest on home loans at repo plus 2.5, and second, you are paying 7% fixed and receiving repo plus 2% on your agreement. At current repo rate, home loan is 6.5%, you pay 7% and you receive 6 because 4% is repo plus 2% is what you were getting. So you will get 6%. The net effect is 6.5% plus 7% minus 6, which is equal to 7.5%. If repo increases to 5%, home loan 7.5, you pay 7 fixed and receive 7, and your net effect is still 7.5. Now let's say repo increases to 7%. Your home loan rate will be repo plus 2.5, which is 9.5. You are still paying 7% fixed and receiving 9%, 7 plus 2. So the net effect is still 7.5. On the other side, if repo reduces, let's say to 3%, you see the numbers, you will still have a net effect of 7.5%. If you observe, irrespective of the repo rate, your interest rate is now fixed at 7.5% because of this agreement. This agreement is known as interest rate swap. We have converted a floating rate loan into a fixed rate using a simple swap. We can do the opposite as well, convert fixed rate instruments into floating rate using these swaps. In my video on floating rate funds, I said that fund managers either buy floating rate debentures or convert fixed rate debentures into floating rate by entering into swaps. This was the swap I was talking about. Let's say a fund manager is holding a debenture that pays him 7% per annum fixed rate of interest. As interest rates rise in the market value of the debenture reduces, which we call as interest rate risk. If you don't know, check the video which is right now on the screen. The fund manager gets into an agreement to pay a fixed rate of interest, which let's say is 7.5% to another institution, and receive a floating rate, let's say which is repo plus 2.5 interest, and it will work exactly like the previous example. At current repo rate, the fund receives 7% from the debenture, it receives 6.5% and pays a 7.5% fixed as part of the swap. The net effect is 7 plus 6.5 minus 7.5, which is equal to 6%. Now, if repo increases to 5%, the fund receives the 7% from the debenture, no change there. It receives a 7.5% and pays a 7.5% fixed as part of the swap. The net effect now is 7.5 minus 7.5, so it's 7%. If repo increases to 7%, what's the net effect? 7% plus 9.5% minus 7.5%, which is equal to 9%. Again, if repo reduces to 3%, fund will receive 7% from debenture, it will receive 5.5% as swap and pays the 7.5% fixed as swap. So the net 5%. So do you see how the fixed rate of 7% is now converted to floating rate? And by doing this, the fund manager has eliminated interest rate risk. This is how fund managers of floating rate schemes use swaps to get the effect of floating rate in their portfolios. The rate used for conversion is usually repo rate or MIBOR, which is Mumbai Interbank Offer Rate. Swaps are not very common, they are not available on the exchange, so you have to be really a big institute and have customized contracts over the counter with another institute. And that is why you will not find people like you and me individually trying to get a home loan and a swap, like the example which I used. In reality, in India, we don't have that facility as of now yet. So I hope you have understood what swap means, what interest rate swap means, and how it is used to convert a fixed rate of interest into a floating rate of interest, so that the floating rate fund can have a lot of debentures even while having fixed debentures in their portfolios. So please do not forget to like, share, and subscribe to my channel. Don't forget to leave any feedback as comments, because I would really love to hear from you. Thank you. Happy learning.